JP Morgan analyst, still thinks a recession is likely.
Not really. I think the market's concerned that perhaps inflation isn't as low as the Fed would like to see it. Even though there's been disinflation, it's coming down. Growth is slowing. Markets get concerned that the Fed may have to come back and keep hiking rates. We heard that from Kathy just a few minutes ago.
But it sounds like the market also thinks the Fed is done. So here's the thing. On a day like today, purely technical, right? We get the worse than expected data. We don't suddenly have them pricing in, a September hike or anything like that. So why are yields jumping? And then everyone's saying, well, it's just a supply issue. There's going to be, trillions of supply coming down the pike. Okay, fine. But why today? Why is this pushing, everything higher today?
Well, there's a lot of technical movement in the market today. CTAs are pushing the market lower. There's been some selling. They're forcing yields up. We tend to just want to look through that. We want to concentrate on the data. That shows things are slowing down. I know you just talked about ISM. But the one component of the ISM that we spent a lot of time talking about was employment. It continues to decline. You've only seen it at these levels when the Fed has been cutting rates. So either this is something brand new, or the markets, the data in the markets, the economy is telling us we're going to see slowdown.
So you're in the recession and the lower bond yields camp?
Absolutely.
Okay, the 10-year level, next move from here, well, maybe I shouldn't ask you next move, because at this point, who knows, but what's the ultimate move, do you think, in the next 12 months or so?
We see the U.S. in recession somewhere around year end. We see the Fed cutting rates before then. We think they'll have to go down to 2.5% to 3%. We see the yield curve pretty steep. We can see the entire yield curve, say 6 to 9 months from now, 3%.
Interesting. Okay, I wanted to set up Rich Bernstein with all of that said. So Rich, and I know you've been more constructive in kind of saying, everyone's been calling for recession. It's not here. But have people now gotten so bullish it's making you bearish?
No, Kelly, I wouldn't say that. I think to some extent the focus on the ISMs, one has to be a little bit careful right now. Remember, the ISM is just a diffusion index, and it basically asks the question, are things better or worse? So when we were in a pandemic, of course, everybody answered it's better. It's not going to get worse than a pandemic. So things got better. Then things were much, much better than people expected. So then everybody said things are worse. Right? But that doesn't mean, as it would historically, that there's necessarily a recession coming, because the amplitude of those betters and worses is so extreme. So I think we have to take that into account here. Now, your point that you just said a second ago, a year ago at this point, 90% of economists were saying we were either in a recession or one was imminent. I think that's down to about 40% now. Roughly, take or leave a little bit on that. And so, I do think that, a recession's looming out there. I don't see the point to trying to time it and say it's going to start next Thursday at 2:15 in the afternoon. I just don't think that's a fruitful investment strategy.
No, but what I'm trying to figure out, and maybe this was not a fruitful idea, but okay, I've got T-bills over here, at 4 or 5%, depending on. And then I've got the stock market, and I go, well, I know we don't always have to pick, but kind of which one's more attractive? Where's the risk reward looking greater?
Right.
For a while, it seemed like it was T-bills. And then the stocks ripped higher. And now you go, well, do you chase the market here after this move that we've seen? Or do you kind of pivot and go, well, maybe these yields are early? You know what I mean? That's what I'm trying to figure out.
Right. So I think there's two answers two questions in what you just said. One is cash attractive? And I think the answer to that is, of course it is. That's how the Fed imparts monetary policy on the economy. They try to disintermediate as much of the economy as they can. And so, of course, when the Fed wants to try to slow the economy, of course cash is attractive. I think it's unfortunate that investors fall in love with cash. You always have to remember you just date cash, you never marry it. But is cash attractive? Of course it is. And that's the Fed intent in doing that. Now, in terms of the market, remember, our view has been the market's been like a seesaw. And on one side of the seesaw, you have the tech, innovation, crypto, everything sexy on one side. And on the other side of the seesaw, you have literally everything else in the world. I think if you're in the sexy side right now, and I think you do have a lot to worry about. If you're on the other side of the seesaw, I think the menu of opportunities is huge, potentially historically large.
So but then I look this morning and some of the names Dom was highlighting earlier, JetBlue, Norwegian. I mean, these are the travel parts of the economy. This is the everything else, and the stocks look terrible.
Yeah, but then let's look at the other side. I mean, nobody's talking about how China has outperformed the NASDAQ 100 substantially over the past 2 months. So there are things going on that are more optimistic. Nobody talks about how Caterpillar's earnings growth has been superior to Microsoft's for 9 of the last 10 quarters.
Wow.
Nobody talks about this kind of stuff. So there's lots of opportunities on those other sides of the seesaw. I get it. Not every opportunity is going to pan out. Believe me, I wish I could tell you the ones that weren't going to. But I think if you're looking at where the risk is, which I think is the point to your question, the risk is definitely on that high side of the seesaw right now.
So in last sort of thing, I'll press on this, but I look at a stock like Caterpillar, and I think a lot of people look and they go, geez, maybe I should have been in that one, for the past year. But do I get in now, right? It's at all-time highs. They just had this most amazing, I don't know how the news on their business lines could really get any better. And you just go, well, all right, maybe that's what's supposed to happen, but maybe I'm going to be the sucker.
Right. So I don't want to advocate for Caterpillar one way or the other here. I don't want anybody to misunderstand what I'm saying. But I think, look, the best example I can give you is we all know ARKK. Right, the ARK Innovation Fund. Since ARK came public in 2014, small and mid-cap industrial companies have outperformed ARKK. Right? Maybe there's a story there somewhere that people are missing, and that's what we're trying to get at, is where are these stories that people are overlooking?
Fair enough, Bob. I will give you the last word. So you are in the camp. I've heard some very, very smart people saying, even if we get a slowdown, even if the Fed has to cut the short end, don't assume that the long end is going to follow suit. Maybe we're going to go back to a world of normalization where the 10-year trades at a 1.5 premium to the short, like you said, steeper yield curve and things like that. Maybe 4% could be a home for the 10-year for quite some time, even in a slowdown scenario. Thoughts about that?
Yeah, we've done a lot of work on that. We're calling it the cash trap. For sure, 5.25% in cash is very alluring, but what we've seen is we've looked at the last Fed rate hike and the returns in the market 2 years after that, and we've compared that to cash. The aggregate bond market has outperformed cash by 13% on average during that 2-year period. That's telling us the bond market's just too cheap. Real yields in the bond market are not repriced for the last couple of years. They're as cheap as they've been since 2007. There's been a generational repricing in bonds.
All right.
I am in the camp that a recession will start soon. Credit card and other delinquencies are skyrocketing and oil prices are increasing again. Let me know what you think in the comments below.